I just added a brand new stock to my portfolio. One of my holdings jumped up 17% after hours, and Amazon AWS went down and took everything with it. It's been a little while since I've done a stock video, so let's just get right into it. So for those of you who don't know, I'm a dividend growth investor with a long time horizon. So I typically pick stocks that have a low starting yield but very high growth rate. And then I found armchair income. Now, I'm not going to completely change up my investing strategy, but this guy is an income investor through and through, and I've been learning a lot from him. I think he's a really knowledgeable guy, and I've come to find out there are safe and sustainable high-yielding dividends. One of those being Hess Midstream. So Hess Midstream is a midstream oil and gas company that has a total return of 180% over the past 5 years. That beats out the S&P, that beats out QQQ, and it has a starting dividend yield of above 8%, and potentially even better, it's grown their dividend at a rate of about 10 or 11%. That is phenomenal. And while I really only plan on keeping about 10 to 15% of my portfolio allocated to these high yielders, this does meet my criteria, which is just essentially 5% starting yield, a growth rate that exceeds the rate of inflation, and ideally a sustainable payout ratio. But let me take you over to Qualtrim and the investor presentation so I can show you some of the things that convinced me. So taking a look at my high yield portfolio, I don't know why it shows this as the dividend yield because every asset in here pays above 5%. But looking into Hess Midstream, it looks really good. Across the board, it's pretty much double-digit revenue growth every single year, EBITDA growth again. Pretty much every metric has seen double-digit growth. Net income isn't the most consistent, but since 2020, it's been a pretty consistent ride-up. Dividends, they look freaking perfect. I love them. I will say, shares outstanding has not really made me happy. And even if we scroll back up to their payout ratio, that's really, really high. I don't like that. But we'll talk about that a little bit more in a second when we get to their investor presentation. But they've also seen very high return on capital employed. I really like this because usually if you have a high return on capital employed and or return on invested capital, that causes a lot of share price appreciation. And after this big drop in price that they've had recently, it's pretty safe to assume they'll start doing some share buybacks as well. But moving over to their investor presentation, this is what sold me. So they have long-term commercial contracts extending through 2033. They have 100% fee-based contracts to minimize commodity price exposure. So if the price of oil is moving up and down like crazy, you really don't have to worry about that much. We can still see consistent growth in Hess Midstream. But they also have minimum volume commitments set on 3-year rolling basis, currently set through 2027, intended to provide some downside risk protection. This is primarily the reason I purchased, I'm not going to lie, because if that dividend ends up not being sustainable throughout 2027, 2033, I'll just cut my losses there. But until then, I think we can see a pretty solid increase in not only the share price, but the dividends as well. And if you look, 80% of their revenues are protected by these minimum volume commitments. So they are contractually obliged to do pretty good. And if we scroll down, their adjusted free cash flow does cover their distributions. They're planning on lowering their leverage over time and essentially just providing an even more sustainable dividend. I'll link the investor presentation if you want to look a little bit deeper. For me, it was really only the first few pages that I wanted to talk about. But they also target a minimum of 5% dividend growth every single year. But as you've seen, we've pretty much doubled that, which is amazing. It's not the most thorough deep dive ever, but an 8% dividend yield with a 10% growth rate and downside protection is just something I could not pass up as an income investor. But if we move on, we have probably the greatest stock I've ever seen in terms of metrics. I just want to show y'all this. So sitting at a 157% gain is the 4th largest stock in my portfolio and one of my absolute favorites. So first of all, right off the bat, 7% payout ratio. This dividend is unbelievably sustainable. Like unfathomably sustainable. Oh my goodness. Aside from that, consistent growth up and to the right pretty much across the board. And as you can see recently, it has been skyrocketing. Their top line, their revenue, 10% growth rate or 10-year growth rate of almost 20%. That's phenomenal. But over the past 1 and 2 years, it's been above 30%. Unbelievable. EBITDA has also been skyrocketing as well, 67% year over year. Net income and earnings per share, pretty much same thing, blasting off like a rocket. Look at the 10-year average earnings per share, 33%. That is unbelievable. I can't even believe I'm looking at these numbers right now. Free cash flow per share, again, 40% 10-year average, 86% year over year. Stock-based comp adjusted free cash flow per share. I'm stumbling over my words here because this is astronomical. I can't even fathom these numbers. They have way more cash than debt. Look at this. It's pretty hard to go bankrupt when your balance sheet looks like this. I'm going to save the dividends for last because it is unbelievable. But remember what I said about return on capital employed? A lot of companies will have high return on capital employed, but it'll be flat. With this company, it's been consistently rising every single year. And so far in 2025, it's sitting at about 34 or 35%. Unbelievable. They buy back shares. If you didn't already think this was a compounding machine, with both of these metrics, I think it's safe to say this is. But my absolute favorite, let's take a look at these dividends. 24% 10-year CAGR. Even more unbelievable, probably every other metric. 40% CAGR over the past 5 years, 54% over the past 2 years, and year over year, the dividend is up 71%. I had to take a moment of silence there. Literally, my mind was blown when I saw all of this. And to put the cherry on top of all of this, I'll put a screenshot up on screen. It had an earnings the other day, 17% after hours. That's how much it shot up. This stock has been one of my, no, it's been my best performer. This stock has been my best performer, and it continues to reward me. I love this stock so much, and if you want a little bit of a deeper dive, I'll link my video to it, but sorry in advance for the poorer quality. Comfort Systems continues to be one of my favorite stocks in the market, and just like the downfall of every other investor, I wish I would have bought more. I just didn't have a ton of money, but next time it's undervalued, I will be a bit more prepared. But that brings us to Amazon. Honestly, I don't have much to say about Amazon, but I just wanted to talk about this whole AWS situation. If you hadn't seen it or gone online at all during the time it was happening, Amazon AWS went down because of some system errors in their data centers, and that caused pretty much everything it felt like to go down. Of course, Google was still up, and I guess everything that Microsoft owns, but of course, the actual Amazon website was down that everyone uses every single day. But Qualtrim was also down. I couldn't do any of my stock analysis, and everyone in the Joseph Carlson Discord was saying the same thing. Robinhood even went down. I think even Webull went down. There was a lot of stuff that was just completely bricked and useless that day. I can't remember exactly when it happened, but I will say I have a little bit of money in Amazon. They don't pay a dividend, but as Nathan Robert puts it, it's essentially an ETF at this point. There's so many levers this company can pull, and it's really only getting better as time goes on. Their margins are getting better when historically they're a very low margin business, but that combined with their future robotics potential, I think is a nasty combination. Now, again, I am pretty much only dividends, but I am willing to hold out on this one for a little bit longer. And what's crazy is I actually was contemplating selling it so that I could use the money and invest into stocks that I just thought were a really good opportunity at the time. But if I felt like selling it at this point, I definitely don't feel like selling it now. I almost forgot how much the world relies on Amazon. Again, it's not going to be a major long-term thing unless they start paying dividends. But for now, I'm willing to hold a little bit longer. With that being said, that wraps up this video. I hope you got something out of it. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.